nobody likes to pay taxes, but everybody wants to have more government services. And when those two items are presented to politicians, they say, okay, we don't have to raise taxes. We might even cut taxes, and we can provide more public services. And all we need to do is put it on the credit card. In other words, to borrow a lot more money. So I think this is, normal short-term political thinking. Politicians often think about what will be the best thing for them to do to win the next election, which could be as early as 2 years for a U.S. congressman. And so I think we've gotten into this situation, which is a problem that was identified long, long ago. The bias toward keeping taxes low, but increasing spending and putting it on the credit card. In other words, running up public debts. I think we've gotten to the point now where it will be a problem if something isn't done about it.
On this episode of the What the Finance podcast, I have the pleasure of speaking with Richard Sylla, who's a professor emeritus of economics at New York University, and your primary areas of research include historical studies of money, banking, and finance. So, Richard, thanks so much for coming on the podcast today.
Glad to be here.
No problem. And I'm really looking forward to our conversation because I guess probably for a lot of us, it's these recent few years of interest rates, inflation, all these other things that have been happening in the economy and I guess globally, we probably haven't seen, especially younger people like myself, or even people who are 40, they haven't seen sort of such a phenomenon. So I guess from your perspective, how can we compare this recent economic actions and monetary policy actions to the past? Is that normal? Is it normal? How does that work?
Well, I think I'm a little bit older than you are, Anthony, and so I've witnessed what's gone on for half a century or more. And I would say that the recent actions are, I think you may be referring to the very low interest rate policies that are sort of been corrected lately. It's not totally abnormal. In the early 1990s, there was a brief recession in the U.S. and savings and loan crisis, and the banks had some problems. And the Fed fought that economic slowdown of the beginning of the 1990s with a low interest rate policy. We had extremely high interest rates at the beginning of the 1980s, and then Paul Volcker came to the Fed and broke the back of double-digit inflation, and the inflation rates were coming down. So the Federal Reserve in the early 1990s decided to fight the slowdown with reducing interest rates. So they pushed it down from the double-digit levels that had been effective around 1979 to 81 under Volcker. They actually pushed the policy rate down to 3% by 1993. And that seemed to be consistent with an economic recovery. And then the Fed followed up on that. The recovery was actually fairly strong, and the Federal Reserve followed up on that by raising interest rates. Then we had the dot-com bubble burst in the early 2000s, and the Fed fought that particular slowdown, a brief recession in the year 2001, by reducing its policy interest rate to 1%. They hit a low of 3% in 1993. They hit a low of 1% in 2003. And then they began to increase starting in 2004. They began to increase interest rates. But then the global financial crisis happened. And the Fed met that by reducing interest rates basically down. They had 3% a low, and then they had a 1% low, and they reduced it to basically zero in the decade of the 2010s. And of course, then there was a bit of a recovery. The Fed was tightening up a little bit in 2018-19. Then we had the pandemic, and the Fed met that policy, that economic slowdown, very sharp slowdown, because everybody stayed home from work, or many people did, by reducing interest rates again to a very low level, and create a lot of money. So, I mean, we've had this pattern of whenever what seems to be either a minor or a major problem come up, the Fed would reduce interest rates to progressively lower levels, 3% in the 90s, 1% in the 2000s, 0% basically in the 2010s and after the pandemic. So what got us to our current situation is not exactly unprecedented.
Yeah, and I can imagine, if we see what's sort of occurred during that period as well, as fiscal debts have increased, lots of other debts have increased, I guess private debts as well. So that's something that's potentially different to, I guess, you mentioned in the 90s where or even the early 2000s where interest rates increased, there wasn't as much debt. So I feel like is what the Fed have done recently with the very accelerated increase in interest rates, is that sustainable in the current, I guess, sort of debt cycle that we're in?
Well, I think we should probably distinguish between public debts and private debts. I would say that, the low interest rate policies, of course, encourage private debt. If you can borrow at very low rates, people are going to borrow a lot of money. So that we see that in the housing markets and commercial property markets, and in general, even in the bond market and the stock market. I mean, when rates are very low, people tend to borrow money. I saw companies in recent years that actually were making a lot of money and didn't need to borrow money. They just did because they thought interest rates were so low that, why not borrow a lot of money and then use it to buy back our stock. That was a pattern in recent years. And so that private borrowing is encouraged. I think there is a problem with public borrowing in the sense that, nobody likes to pay taxes, but everybody wants to have more government services. And when those two items are presented to politicians, they say, okay, we don't have to raise taxes. We might even cut taxes, and we can provide more public services. And all we need to do is put it on the credit card. In other words, to borrow a lot more money. So I think this is, normal short-term political thinking. Politicians often think about what will be the best thing for them to do to win the next election, which could be as early as 2 years for a U.S. congressman. And so I think we've gotten into this situation, which is a problem that was identified long, long ago. The bias toward keeping taxes low, but increasing spending and putting it on the credit card. In other words, running up public debts. I think we've gotten to the point now where it will be a problem if something isn't done about it. It's not the end of the world. I learned from my colleague Neil Ferguson, a British historian who's spent his last 20 years in the United States, that the British national debt was close to 250% of GDP after the Napoleonic Wars, in 2 centuries ago. And so I don't want to be too gloomy about this, because somebody might have looked at Britain in 1815 or 1820 and said, gee, we have this huge debt, the outlook is going to be bad for us. In fact, the next century was about the best in British economic history, the Victorian era, the Industrial Revolution. So I don't want to be too pessimistic about it. But it seems to me that there's a little bit of fiscal irresponsibility in many governments now, and I would like to see some people tackle it and say, we can't do this forever. We can't put everything on the credit card. I mean, you and I know, and your listeners know, your viewers know, that you can't put everything on the credit card indefinitely because there's a day of reckoning. And I think the same thing applies to public debts. And so I think it's time for a few doses of fiscal responsibility around the world.
Yeah, I definitely agree. And I guess if people would link back to maybe those points, and as you said, after the Napoleonic War, debt to GDP was outrageous in the UK. If we go back to World War II, it is very high. Same in the US.
Right.
And really, the way they got out of that was depreciation of their currency. So
Yeah,
I
in
feel,
fact, the World War II was probably the highest ratio of public debt in the United States to GDP. It was a major war both in Europe and the Pacific. And in 1945, 46, I think the national debt was like 130% of the GDP. And by the 1970s, that was down to, I think, 40% or less, mostly through economic growth. The debt was basically stabilized and the economy grew. But now we're back up to roughly 120, 130% of GDP to the total U.S. debt. You'll see figures lower because sometimes they don't count the debt that the U.S. government owes itself, but that pays for Social Security, so it's really a debt that has to be paid. So I think that the difference now and between now and the end of World War II, when the national debt as a proportion of GDP was about the same, is that there's no sign now that we're going to stabilize the amount of debt and let the economy grow up to reduce the burden of it relative to GDP. It seems like we're still putting things on the credit card, and the debt forecasts are that the debt to GDP ratio will just continue to rise for the next few decades. And that's not a good sign.
No, and I find it hard to see where that growth would come from. I guess you could say maybe AI and this new productivity revolution, but they're very much long shots. I feel like compared to, as you said, the need to be fiscally responsible and maybe not austerity, but just to bring it back to trying to balance as much as possible.
Yeah, I mean, there has been a bit of a slowdown in economic growth relative to let's say, the uh, decades from World War II to the year 2000. But there is still some growth. Uh, it's a bit lower. But as you say, AI, I mean, we don't know what the next innovations are that may speed up growth, and so we have to keep an eye on that. But I'm not sure that the era of economic growth is over. We may just be going through a slower period. The last 230 years or so, roughly the period of the existence of the United States have been, remarkable economic growth first in some countries, Western Europe, North America, later on Japan, and now it seems to have spread, to the whole world. That the whole world has gotten on the economic growth bandwagon in recent decades.
I guess have those countries been so if you mentioned the whole world, that obviously China is one of the bigger beneficiaries, India recently, a few other countries throughout Asia, and I guess you could say Russia until recently, and those other BRICS countries. Have they sort of been not stealing, but have they been maybe taking that growth away from US and away from those Western countries? Is that how it works?
Well, I don't think they're taking the growth away. I mean, the rise, so let's say the rise of Germany and Japan in the late 19th and early 20th centuries didn't take away from the growth of the earlier industrializers like Britain and the U.S. Um, uh, I think it was, it was just a spread of economic growth to the whole world. I mean, and it's basically a good thing. I mean, at the end of the 20th century, there were, the last decades of the 20th century, the world was a very unequal place, in the sense that places like India and China were, much below the world average of per capita income. And they're showing signs. I think China's gotten back up to about the world average of per capita income now, and that's a good thing. Um, there are some, trade policy differences in the United States. People fret too much, I think, about our trade deficit with China. But I think, in fact, people fret about trade deficits too much anyway. It's like the old mercantilism. You want to have a favorable balance of trade. So if you don't have a favorable balance of trade, if you're not exporting more than you're importing on goods and services, something must be wrong, and the people you're trading with must be cheating. But I have a kind of view which I've stated. It hasn't gotten a lot of resonance with other people, but the history of the U.S., there were a lot of trade deficits throughout our history. Uh, and I almost look at it as, the general view of economists is that there's a real world of production and consumption, and then there's a financial world. Uh, and the real world rules the financial world. But I would at least venture the argument that that may be the tail wagging the dog. And when I look at U.S. history over a couple of centuries, I say, the U.S. has always been a pretty good place to invest, and the rest of the world want to invest here. And so how could they get the resources to invest in the U.S.? Well, the U.S. had to buy more from them than it sent to them, and that would give the foreign countries a supply of dollars to invest in the U.S. and that may have been the dog, in at least in some eras of history. So we shouldn't minimize the role of finance and the attractiveness of investment. So in some sense, we Americans need to import more from the rest of the world than we export to the rest of the world, because the rest of the world wants those dollars to buy Apple stock and Microsoft stock and Amazon stock, and maybe even some, if you're concerned with safety, U.S. government debt, which is supposedly the world's safest asset.
Yeah, and I guess as long as those investors want to come into the US and invest in those assets, then this deficit
Yeah,
shouldn't be an issue.
we poor Americans, we just have to buy more from the rest of the world than we sell to them to satisfy their need for dollars to invest here.
Yeah, it's really interesting when you think about it like that. So I guess if we look at maybe what's happening recently with the increased inflation due to supply issues and other factors, do you feel that I guess what the Federal Reserve has done has been enough to, I guess, stimulate that inflation and reduce that inflation? Or do you think that maybe we're in a similar state to maybe mid 70s where we saw inflation drop and then we had a sort of a big peak before Volcker came in?
Yeah, well, in the 1970s, it was sort of a stop-go policy at the Fed. There'd be inflation, and the Fed would tighten, and then the economy would slow down, and unemployment rate would go up, so the Fed would loosen. And the result of that was a sort of progressively rising rate of inflation, without a lot of progress on getting unemployment down. I think what the Fed is doing now, I mean, it's sort of correcting a mistake it made in the year 2020 in response to the pandemic. Um, the U.S. government basically borrowed a lot of money, and sent out checks to people who were unemployed because of the pandemic. They couldn't go to work, and all kinds of aids were given to get us through that. And I think they worked in the sense that with the financial crisis. I mean, the stock market went down for very sharply for 1 month or so, and then both the markets and the general economy came back. So in some sense it worked, but when I saw, like in 2020 and 2021, that our American money supply, I'm a bit old-fashioned. I still have some monetarist leanings. And when I saw that the U.S. money supply was growing at the rate of 20 or 30% a year, I said, gee, in most of history, that meant we could expect a higher rate of inflation. Well, that higher rate of inflation began to show up in 2021. At the time, people said, well, that's just transitory, it's transitory inflation. And economists divided themselves up as to whether they were on team transitory or they thought that it was a more serious problem. By 2022, it became apparent that the inflation was not so transitory. And so then the Fed decided to step on the brakes, and that's what they've been doing for a little over a year now, raising interest rates, sometimes fairly sharply. And general economic analysis would suggest that the way to get the inflation rate to come down, you may have to raise interest rates up at least to wherever the rate of inflation is. And that's kind of what happened. The Fed has raised interest rates from near zero up to around 5%. In the meantime, the inflation rate, which was 7 or 8 or 9%, has come down to the 4 to 5% range. So I think the Fed has done so far what it needed to do, and depending on what the upcoming data show, it may have to continue that for a while. But I think they did the right thing. But in a sense, they're correcting their own mistake from earlier. Uh, and whether that mistake was justified or not, I mean, there was a pandemic, and it had serious economic effects. And the government met that by spending a lot of money, and the Fed helped the government by buying a lot of its debt. And so, maybe that was worthwhile, but we should not be surprised by the fact there was inflation, and it's not exactly transitory. And it's probably going to take a little longer to get it down to the Fed's target. And the Fed does seem to feel like it wants to get back to 2%. That's the latest argument in economics. Should you really try to get back to 2%? Or should you be willing to live with 3% or maybe even a little above 3%? The economists now are debating that. They've gone from debating whether inflation was transitory or not to debating whether 2% is justified or should it really be 3%. We'll see how that plays out over the coming months and years.
Yeah, it'll be very interesting to watch out. And I feel like there's also this other camp where it's like the inflationists saying it's like, oh no, this is just a temporary push down, and we're going to see, core inflation and other metrics become more sticky. Or there's a sort of deflationist saying that the Fed's going to push everyone or push the economy into a massive recession, and they're going to have to sort of really pivot and cut rates quite quickly. Do you have any thoughts on what you think will be more likely?
Well, there's been a lot of discussion of, there are so many signs based on past history that we should be moving toward a recession. In fact, many people are surprised that it hasn't shown up yet. Uh, inverted yield curves. And one thing I like to watch is the price of copper, which, I was one who was thinking the Fed policies probably would cause a recession, but I was puzzled for the last year when the price of copper seemed to be staying up fairly high, and it was over $4 for a while. And lately, the price of copper has come down, but not a whole lot, into the three 50 to $4 range. And so I thought that was a sign that a confirmation that we may be heading toward a recession, but it hasn't continued to come down. Uh, and I still think there will be a recession, but it hasn't come yet. I think that's the next piece of news that may show up. I mean, there'll be an economic slowdown. I mean, maybe some people will find a term where they don't call it a recession; they'll call it something else. But I think a slowdown is in the works. And one of the reasons for that, as I mentioned, that was the increases in money in 2020 and 2021 that produced this inflation. And I think could have been forecasted at the time, but a lot of people don't pay any attention to money anymore. Um, and now, for the last year or so, the money growth has turned negative. And in the past, that's usually a sign, almost like an inverted yield curve or a falling price of copper, that an economic slowdown, let's call it a recession, is on the way. Um, so we'll see. It's kind of a test of, maybe I will have to abandon my feelings about the validity of monetarism, or the money growth is important if we don't have a recession. But the negative growth of U.S. money has been in the past a sign that something like a recession is on the horizon.
Yeah, those are some great points. And it'll be interesting to see what the Fed does, especially if maybe unemployment doesn't change. Because if we look at it, we saw some big job cuts through, the tech industry, I guess at the end of last year, start of this year. But other than that, we haven't really seen too many job cuts and too much pain in the employment sector. So it'll be interesting to see that if we do see the slowdown and potentially not as many loss of jobs as expected, whether they would pivot or whether they would
Yeah,
remain higher for
I think
longer.
that one of the big surprises is the strength of the U.S. labor market, um, because I would have expected to see a little more weakness now, given negative money growth for a year and the rising interest rates, and there's not much sign of it. Which I'm glad of that. I mean, I don't really want to have a recession, uh, so I'm trying to figure out exactly why that's true. But it is, of course, some people left the labor market during the pandemic, COVID crisis, and they seem to be reluctant to come back. But and that is making for tight labor markets. But there doesn't seem to be any sort of, any signs that the labor market is weakening. So it's just one of the interesting. The U.S. consumer is doing what the U.S. consumer usually does, and that's go out and spend a lot of money, and that's helping to keep these strong labor markets.
Yeah, and I think I've seen some statistic somewhere that says that maybe hours worked is decreasing. So maybe rather than, these employees took so long to actually employ these people, there was quite a tight labor markets, and now they're trying to do whatever they can to prevent letting them go. So maybe reducing the hours and doing other things to
Yeah, they're
save
the
money and not
labor
living.
economists. I'm not one of them, but they really, look under the hood, so to speak, and find out what's really going on in different labor markets. And, I guess people reach different conclusions from that. I mean, I've seen reports that the strength of the labor market is exaggerated if you actually go down and examine what's going on. But I haven't gone into those weeds so deeply yet.
Yeah, it makes sense. So if we maybe go back to interest rates, and as you said, you sort of studied the, I guess, financial history. Has there ever been a point where interest rates have gone so low and then they've come back up without there being crises? Because I guess if we look at, going to 0% it is quite extreme, and then going straight up to 5% in less than a year, it's
Yeah.
been very
Well,
accelerated.
Well, I mean, I would say that what has happened so far with interest rates from a historical perspective is just a normalization of rates from extremely low repressed levels. Um, 4 or 5%, 4 to 5% on U.S. government long-term bonds, so maybe 3% on shorter-term U.S. instruments. These would be perfectly normal for much of my lifetime, which goes back 8 decades or so. And so I see this as a kind of a normalization. But to anybody who's not as old as I am, and that's just about everybody, it looks like, oh, gee, interest rates are really high now. They're not really high in any historical perspective. They've gotten back to normal, and we should also think about real interest rates too. In a certain sense, the nominal interest rates have gotten back to normal, but real interest rates are still quite low. If the Federal Reserve's policy rate is 5% and the inflation rate is 5%, that's equivalent to like a zero real interest rate. And so I don't think that young folks should think that interest rates are extremely high now. They're a lot higher than they were a couple of years ago, but they are not high in any historical perspective.
And what is normally the real interest rate? I guess what is the average?
Well, I think the real interest rate sort of reflects the, in a basic sense, and maybe some models could show it, something like the growth of the economy. If you think about it, that's, if an economy is growing at 2 or 3%, then you might think, a real interest rate ought to be around 2 or 3%. Uh, and I think history shows that for longer term analyses would suggest that there is a relationship between real interest rates and how fast an economy is growing, at least in the modern world, not in the with modern finances and all that. It wouldn't be true for periods much before the Industrial Revolution, but interest rates were typically higher then, but there was much less finance then too. Today we have a lot of finance. In fact, some people worry that we have too much finance, and they coined this adjective financialisation, or I guess it's a noun, financialisation, the financialization of the world. Uh, well, I think that that's not really such a bad development, and modern finance offers a lot of advantages to the economies that have it. Uh, but so there is a young scholar named Paul Schmelzing who's studied like 800 years of real interest rates, and he announced, much to the surprise of many people, or in papers he was writing maybe 4 or 5 years ago, that when interest rates seemed very low, he was saying, these interest rates aren't really low. I mean, they're just a continuation of the long-term trend. We should get used to thinking about interest rates that are hovering around real interest rates that are hovering around zero, because that's just where the projection of the long-term trend, and his long-term trend was like for 700 or 800 years. He felt like when interest rates seemed to be zero, that was sort of normal. Most of us thought they were low, but he argued that they were zero. Um, Zero was not what you sort of expect, and he expected it to stay that way in the future. Well, if we have inflation of 5% and interest rates of 5% in the future, I guess the real interest rate will stay around zero. But in any case, history does give a food for thought on where interest rates are now. In my lifetime, by the way, I've seen the highest rates in U.S. history. That was about 40 years ago, 1979, 80, 81 under Volcker, where banks' prime rates got up to 20% and mortgages were 18%, and U.S. government bonds yielded 14 or 15% for 20 to 30 years. And So those were very high rates. And then lately I've seen these rates that are close to zero or even negative if you take account of inflation. So um, I've only lived through 1/3 of the history of the United States, but in that 1/3 of the history, we've had our highest and lowest interest rates.
Yeah, it's amazing to think, and I'm interested to hear your thoughts on financialization because I guess overall it has been a massive benefit, but there is I guess like anything, if it goes too far to one extreme or too far to the other extreme, then it could be a disadvantage. I guess we saw that in 2008, and maybe some people would link that to today as well, where this financialization is could potentially have massive impacts. And I guess we look at what's happened with SVB with financialization of assets and using it as collateral, and when there's these big changes in value of those assets that can have an impact on some of our institutions.
Yeah, when you see, creations like SPACs and crypto assets, and I mean, sometimes I think financialization can be carried a bit too far. But in my career as an economic and financial historian, I've decided that modern financial arrangements, which were achieved by countries like the Dutch Republic or today's Netherlands, 400 years ago, and by Britain, say 300 or so years ago, and by the US, 230 years ago, and Japan in the late 19th century, that basically modern financial development has spurred economic development. And you could call those previous periods of creating central banks and current stable currencies and national debts and stock markets and creating a lot of corporations and banking systems. You could say that those things were financialization. My view is that they were basically really good. The people that financialized that way earliest tended to do the best economically, like the Dutch, the British, the Americans, the Japanese. And so financialization historically has been a good thing, and maybe one of the chief propellers of economic growth. But you can have excesses. The whole history of modern finances, it shows that there are a lot of excesses leading to financial crises. Booms and busts. People study them a lot in history. We can learn from them, and so I think there can be excesses in the financial system that have to be corrected. In recent years, recent decades, we had the savings and loan crisis. We had the dot-com bubble in the United States. We had the global financial crisis. We had the COVID crisis. Sometimes finance reacts to those, but sometimes finance is sort of part of the cause of them.
Yeah, and it's interesting you mentioned those countries. I guess you could say that some of them have probably been negatively affected by these massive booms and busts. And you could say Dutch disease, Japan's I think only recently has recovered from its
Yes,
yeah.
that's an interesting case. Japan, first they had a lost decade, then they had a couple of lost decades, but they haven't really gone negative. I mean, the Japanese growth has slowed down considerably, but certainly there were excesses in Japan in the late 1980s. When they said the palace grounds of the Emperor of Japan in Tokyo were worth more than all the real estate in the state of California. That was sort of a sign of excess, and golf club memberships were sold for millions of dollars. And, the Japanese went on a buying spree around the world of art and buildings and things like that. So that was certainly a sign of excess. And it seems like it's taken a while for Japan to recover, but they're still a fairly rich, prosperous country.
Yeah, it sounds like a similar country that that we've seen recently with China. We'll see if it sort of ends the same way. But yeah, it'll be
Yeah,
interesting to
I'm
see.
actually surprised that the Chinese haven't had they've had remarkable economic growth for roughly 4 decades now. And usually in history, you don't see anything like that without some kind of financial crisis or slowdown along the way. And I'm trying to figure out what's going on there. And I guess the Chinese government sort of jumps in quickly and takes measures to alleviate these what sometimes seem to be financial excesses in China. But it is really unusual for a country to grow as much as China has for 4 decades without having some sort of even minor or major financial crisis. Their securities markets have had their ups and downs, but they haven't had really a major crisis, and people have been forecasting one for a long time. We all talk about the Chinese overbuilt apartment buildings and things like that. Uh, well, somehow the money that was borrowed created debts that have to be serviced, and there are signs that maybe some of the companies won't be able to service them, but who knows? I mean, I've been wrong for a long time thinking China was due for a financial crisis, and it hasn't come.
And I guess is this, as you said, they're very quick to, I guess, come into the markets and to do what they can to support it. And I guess you could say US and other countries have just started to do this as well. Is this just kicking the problems down the road? They're just doing whatever they can to.
Well, there may be some of that, but yeah, I mean, I think the Chinese government has been much more proactive than the governments of other countries in trying to prevent finance. They help banks that have non-performing assets. That's a term I taught in China a couple times in a decade or so ago, and everybody's talking about the non-performing assets on the books of the Chinese banks. Well, somehow the government would come in and help remove those non-performing assets into some other, companies, and the banks went on lending. So I think the Chinese government has been more proactive than most countries' governments have in coming to the aid of the financial institutions that might be having problems.
Yeah, it makes sense. And I guess you could say the maybe America's starting and the Fed is starting to do that with. I guess you could say treasuries probably aren't non-performing assets, but you could
Yeah.
say that they have come in to save these institutions as well.
Right, and this year, not so long ago, we saw a pretty dramatic intervention to save all the depositors, not just the insured depositors of Silicon Valley Bank and Signature Bank and First Republic Bank, and so I would say that's we have to put that in our pipe and smoke it. It looks like governments, maybe other governments are learning from China that when there are financial problems brewing, let's jump in and solve them before they spread and cause a really bigger problem. And that may be what's going on now. And what does it mean for the future? Well, to me, it means there's probably more inflation in front of us. I mean, I think that uh, and I mentioned we talked earlier about the massive size of government debts and borrowing in general. Private debts, private debt indebtedness is up a lot too. And one of the first things I learned in economics is that inflation is good for debtors and bad for creditors. And then I say, well, the government has the ability to cause inflation by printing more money. And the government's also the biggest debtor. So I would say going forward, from right now with all those debts, public and private, that inflation will be, governments will say, well, a little inflation isn't such a bad thing because it reduces the real burden of the debt. And, if you're intervening to bail out financial institutions, and you have a big debt yourself, it seems to me it'd be very easy for public officials to get into a mode where they say, well, inflation isn't really so bad. And that's something I think that we should all be watching, because if we're in for a period, I mentioned there's a debate in the US of whether we should get back to 2% inflation or will 3% be okay. I think if I read the tea leaves, the 3% guys are the ones who say maybe we can even live with 4%. They maybe have a stronger case for what's actually going to happen than those who say we'll easily get back to 2%.
Yeah, it's fascinating to think how it's all interconnected. So I know before we started this interview, you wanted to mention more about, I guess, looking at the long term, and sometimes, especially for young people, we've only been maybe in the market a few years or even a decade, and we probably haven't seen a financial crisis. So it's taking a step back and looking at the historical history and where today compares to the past. I'm not sure. Yeah, what was that message that you were looking to share?
Well, I just think that individuals, have not an infinite lifetime, but presumably a long lifetime. And when you told me a lot of your viewers are fairly young, I thought, well, that's very good. And so they should plan not just for this year and next, or this month and next year. They should be thinking about, thinking in terms of decades. And one of the lessons of history is that both countries and individual wealth grow by a compounding over long periods of time. This idea of compounding, like the United States, had a population of under 4 million people in 1790. Uh, Now it has a population of 330 some million people, and it started growing at fairly, the best evidence we have lately, or some of the most recent evidence, is that the U.S. started growing at a fairly modern rate, close to around 1% a year, starting in 1790. This is 1% a year of real per capita income. Not a really high rate, 1% a year doesn't seem very high. And it probably went up as high as 1.5 to 2%. But, that went on for like 200 and some years now. Let's say 233 years since we're in 2023. And today, the per capita income, real per capita income of those 332 million Americans is roughly, in the 50 to 60 times higher than the real per capita income of the less than 4 million Americans in 1790. So by growing very slowly, but for such a long time, the U.S. has become perhaps the wealthiest country in the history of the world, uh, and with a very high GDP per capita. The same thing is true for an individual. If you systematically start to save when you're young and invest, and then just let the compounding work for a few decades, you are likely to be very happy, a few decades from now, because that same compounding, which looks like it's not doing very much for you from one year to the next, and maybe even go negative for a year or two, uh, over long periods of time, it's the secret of becoming wealthier. And so, this idea of compounding over time is one that should really appeal to young people, and they ought to study it a little more. I've studied it for countries and for individuals, and you see that that's really the one of the secrets of economic development, personally and for nationally, for nations and for people. They all take advantage of compounding.
Yeah, it's fascinating to think what 1 or 1.5% a year can can really do.
Yeah, it's hard to believe, but I mean, this let's say the average rate over 2+ centuries was about 1.5% a year. We wouldn't be very happy if our stock investments only gave us a 1.5% yield, uh, but that's what a country like the United States did for 230 years. And the end result was that the typical American is, like, in real terms, 60 times richer than George Washington's average American was 230 years ago. 60 times. I mean, that's, nobody's going to live for 230 years, but if you live for 70 or 80 years, and you have a few decades of compounding, you may end up with, 10 or 20 times what you started with.
Yeah, which is amazing to think. So, Richard, thank you so much for your time today. I really appreciate it. I guess my last question is that the message you want to leave people? Is there another message you'd like people to take away from our conversation?
Um, well, since I taught financial history and economic history for 40 to 50 years, and I think I've learned a lot from it. I mean, I've studied the ups and downs of the U.S. stock market for 230 years. And it led me to think that, make predictions that, in 2000, I predicted the next decade would be a bad one because returns got to be so high by 1999, 2000, that I look back at U.S. history that whenever that happened before, the next decade was usually pretty bad. And we had a bad decade from 2000 to 2010 with that global financial crisis. 2011, I said, well, we're really down in the bottom of the barrel now. And I looked at 200 years of U.S. Stock returns, and usually when that happened, the next decade was good. Well, the 2010, 11 to 2021, 22 was pretty good. That's one of the things I learned from history. And since the last decade was good, I would sort of say now that I'm not really thinking that this coming decade will be good. But that's just a lesson of the kind of thing you can learn by studying financial history. And it's not foolproof, but it often gives you I think there's too much short-term thinking in finance. Everybody's, well, what is the Fed doing today or tomorrow or next week? That doesn't really matter much in the long run. We had a 20+% drop in the U.S. stock market in one day on October 19th, 1987. And everybody thought, oh, this is the end of the world. It's a sign the Great Depression is coming back. That you heard that at the time. Now, when you look at the stock market chart, it barely shows up. You can see it, but that huge drop, which made people so worried and pessimistic at the time, looks like nothing compared to what happened afterwards. And so another bit of advice is don't get too hung up on what's going on right now or what's going to go on next week or next month. Take a long-term view and study a little history and make some of your decisions based on that.
It's a great point. And I think if you look at those decades that probably didn't perform too well, there were periods of exuberance where the stock market went up a lot. It's just by the end of the
Yeah.
decade that had reversed.
I mean, there's a tendency to use this history to say, well, be a market timer. But I sometimes have that temptation myself. But I've kind of learned that you can't really know what the market's going to do. And if you're young, you have all this time. So if you make investments, maybe one of the best things you can do is just tell yourself, I'm just going to leave it there. I'm not going to get panicking, because usually when the market goes down a bit, then people say, get me out of there. And that's just the wrong time to get out, because they're getting out when prices are low. And they tend to say, well, the market's been doing well, so I better jump in now. That's the wrong sort of behavior. You want to buy stocks when prices are low. And you probably ought to hold back a little bit on investing in them when they're high. That sounds like market timing. But over the long run, maybe you should just leave your stuff in there and let it compound for you over years and decades. And you're probably better off than trying to guess which way the market's going to go next week or next month or next year.
Great pieces of advice. So, Richard, thanks so much for your time. If anyone wanted to find out more about your work and what you do, is there any way they can do that?
Oh, I think there's probably various websites that do that. I mean, they can get in touch with me, and yeah, I'll send them papers I've written and all that. There are some. There's a site called Academia that seems to have a lot of my papers on it, and they tell me whenever somebody reads them. So academia.com, I guess, is a place where you can find out a little bit about my work.
Perfect. I'll put that in the description below. But thanks again for your time.
Thank you. Enjoyed it.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.